All right, so I'm going to try to carry on now if the internet will actually allow it. We were abruptly interrupted when I was showing you how this tree works for stocks and the corresponding options. So if you recall, the stock price tree is evolving the way I'm showing you down here. We have the current stock price, which is observed in the marketplace, and then we push out into the future. Um, Here we have a two-period model, which means that if this is, let's say, a 6-month option that we're trying to price, that means each time step is 3 months. And so the delta T in between these steps would be a quarter of a year or 3 months. And of course, if you recall, the way that this tree is modeled, we are assuming that when the stock goes up, it goes up by a multiple called U. And when it goes by a multiple called D. And if it goes up twice, we reach the node U squared S0. If it goes up followed by down, or down followed by up, we reach what we're going to call UDS0, although we could easily call that DUS0 because it means the same thing. And at the bottom, if we go down twice, we reach the node D squared S0. Now, although this isn't absolutely necessary, the Cox, Ross, and Rubenstein model is set up so that U and D are inverses of each other. And so what that means then is that if we go up and then we go down and then up, not only are we reaching the same node, but we're actually right back where we started from. Okay. This is in their model. Some of the later models relax this assumption. But the important thing is that we have to make sure that up and then down brings us back to the same point as down and then up. And then we have a recombining tree. If not, we're going to have a tree that gets very big very quickly. Okay. But, some of the litter models don't have that feature either. And for some types of options, that's actually a good thing. Okay. Certain types of options don't work well on the tree that you're seeing here. They're just a little too complicated. But for stock option, this works out just fine. Now, on the right-hand side, we're going to have the corresponding option tree. Now, in Hull's book, he uses the letter F for the option, whether it's a call or a put. And the reason for that is because if we tried to call it C for calls and P for puts, the letter P would get confused between probabilities and puts. So Hull decided to call it F. So the notation on the right-hand side is a little bit different because when you go up or down, it's being driven by what's happening in the stock tree. And so it's not necessarily the case that you or going up or down is going to bring us up or down by a constant amount. Okay, so this is a little different. So we're going to call this F sub U and F sub D. And I'll show you in a minute how those values are determined. Okay. But it isn't necessarily the case on the stock tree. The ratio, for example, of US0 over DS0 is a constant throughout the tree. Over here, it is not the case. Then we would move on to what we'll call FUU, FUD. Okay. And then down here, FDD. So let's assume that this is a call option. So because it's a two-period model, that means that T equals 2 is the maturity date of this option. So that means at time 2, the value of this option will equal the payoff or intrinsic value of the option. So that means in turn that FUU, again, because this is a call, will equal the maximum. Oh, actually, I forgot. In these slides, we're using K. Sorry, in this section because this is in this section of the course, we're going to use the K rather. only because this is what Cox, Ross, and Rubenstein did. But now here's the interesting part. That S refers to the value of the stock over here. There's these two are referring to the same case where the stock price has gone up twice. So I can replace this S with SU squared, or rather U squared S. Not that it matters, but just to be consistent, I'll call it U squared S. Okay. Notice because it refers to a specific node on the stock price tree. And then FUD, based on that logic, must be okay, because again, these two, the option value here at this node is based on the stock price here. And then finally, FDD would therefore be this amount, whatever that is, depends on the numbers we've been given. So for the terminal nodes, which would be these, what about the interior nodes? Well, now this is a little bit different. So now keep in mind, remember, we're assuming that there's a probability P, which is the probability of going up in this tree, and 1 minus P means going down. So I'll just mention that. In the slide, you'll see this G here is the real world probability, but we're not using the real world probabilities. We're using the so-called risk neutral probabilities. That's a risk neutral probability increase when we're going up. And then, of course, that implies, since it's a binomial model, there's only one other thing that can happen. And that means 1 minus P is the risk neutral probability of decrease. So you could actually put those into the tree if you wanted to. Now, also, I want to point out here that this tree is evolving over time. So we're going to actually go from the future back to the present when we price this option. We're going to go right to the terminal nodes and work our way back to the present. Now, let's look at FU. So the logic here is this. The expected value of the option at node here, where at FU is, so in other words, if you're already at node FU, one of two things can happen. Either we go up to reach FUU, or we go down to reach FUD. Okay, so in other words, from this position, if we're at FU rather, either we go up to FUU with probability P, or we go down to FUD with probability 1 minus P. So we think of that as the expected value of FU. Now, the value of the option, though, actually, let me start this here. Since these values are possible values of the option in the future, value of the FU today is the present value of this expectation. In other words, so in other words, why? Why is it written like that? Because remember, we're using continuously compounded rates of return, and those cash flows, the next time step occurs delta t in the future. So this is how we express the present value of FU. And so what we're going to do, actually, no, hold on a second. I'm going to write it like this. This will be much cleaner. It's better. Okay, now everything is set. Okay, in other words, what we're doing is we're finding the expected value of the option at node FU, and then taking its present value. And this is our result. Okay, so we're going to write this as FU equals this expression. So right now, FU, if we're at this node, is the present value of what the expected value of what it will be in one time step. So if that's the case, then what about this FD rather, right here? What would this have to be? All right, well, based on the same reasoning, the value of the option at node FD is, so just look at the graph again, you'll see that if we're at FD, we can go up to reach FUD or down to reach FDD. So what we need then is the present value of the expectation from node FD. Okay, so we'll go up to FUD with probability P or down to FDD with probability 1 minus P, and we discount all that back to the present because these two nodes take place in the future. Now, we're done with these two values. That leaves this one, and that's the current value of the option. So we're going to use the exact same logic, and we'll write it out as a present value of an expected value. So we have to discount the cash flows that could happen in the future. And so there's, from here, we can go up to FU or down to FD. Okay. And this is our final answer. But of course, in order to get to this point, we have to first have figured out FU and FD, which in turn requires us to calculate FUD and FDD. So in other words, you're doing a large number of calculations, starting from the right and working way back to the present. Now, by the way, I might as well add this in here while we're on this topic. If this had been a put, the only change would be that these payoffs would be changed to reflect the fact that this is a put. The rest of the process would be exactly the same. So let me just make a few changes here. So when we reach FUU, if this is a put, This would be, we reverse those two if you recall, and we'll have K minus S0. Oh, actually, sorry, U squared S0. That's better. So we just reverse the two. Like this one is going to become K minus U ds0. And then this last one will reverse the two to give us K minus D squared S0. And the rest of the tree is built in the same way as it was for the call. Okay, so this part never changes. Now, this takes a while. If you're writing a program for this, it takes a while because you end up creating what are called nested loops, meaning one loop within another. So what you basically have to do is have an outer loop that represents time, and then an inner loop that represents all the different nodes within the same time step. So it can get very tricky, but this is how it's working. You're going to the future and working your way back to the present. Now, all of this discussion so far has been based on the assumption that whatever this is we're pricing is a European option. Okay. And if you, by the way, if you were to increase the number of steps for no matter what the maturity of this option is, I've randomly chosen 2 steps. Let's say this is a 6-month option. I have 2 3-month time steps. There's nothing to stop me from having 6 steps of a month each, or 24 steps of a week each. And in fact, when you're writing code for something like this, we often end up creating a lot more of these nodes, because what's happening is that as you keep increasing the number of nodes, the model should produce a price which gets progressively closer to the actual Black-Scholes price. Okay, and the limit, as we keep doing this, we'll get very, very close to the Black-Scholes price. In fact, we can get as close as we need to. All we have to do is increase the number of steps. And in fact, if you actually did go ahead and do this, what you'd probably find is that as you keep increasing, let's say here we have the Black-Scholes price. Numbers above that means you've overpriced the option, and numbers below that means we've underpriced it. Along this, we have the number of time steps along this horizontal axis. And so you'd expect to see a pattern like this. You start out maybe a little too high, then you get too low, too high, too low, too high. And eventually you'll get to the, some within any arbitrary distance of the true Black-Scholes price. Okay. So, and that's because this model and the Black-Scholes model are based on the same assumptions. So they have to give us the same results in the long run. In the way you might recall from statistics that the binomial distribution converges in the limit to the normal distribution as the number of trials increases. And it's the same logic here. Okay. As you keep increasing the number of trials, eventually you'll find yourself converging to normality. So now, and by the way, this is a good feature because it means that we can get some experience trying to figure out roughly how many steps should be needed to get within a reasonable degree of accuracy of the Black-Scholes price. So let's say we discover from doing experiments that all we need is, let's say, weekly steps to get within a penny of the Black-Scholes price. That will help us figure out how to price others like American options where we don't have a Black-Scholes price. So anyway, what now? Here comes the big question. What do we do about American options? How is that process different? By the way, there's a lot of theoretical discussion in these slides about this model. We've already covered a lot of it, but what I wanted you to see is somewhere along the way here, there's a derivation of 2 key formulas. One of these is the risk neutral probabilities of going up and down. Okay, this is the probability of going up. This is the probability of going down. We don't really have time to go through this in great detail right now, but the logic here is that these are the probabilities. Are consistent with earning the risk-free rate of interest on average from the option. In other words, if you somewhere down here, there's a proof, and it shows that if you take the expected value, this is it. Here we go. Okay. So in other words, the value of holding the stock and the option in the future should give us a future value, which is based on the risk-free rate of return. Any other probabilities won't guarantee this. Okay, so this is our discussion. This is, I mentioned earlier how the risk-neutral approach works. Also, one other thing I forgot to mention, I think, is the formulas for U and D. Now, this is coming to us from Cox Russell Rubinstein, the author of this original paper. So here's what they chose. Okay, hold on. Okay, it's here somewhere. Well, all right, we'll find it some other time, but I'll just mention it right here that if you were to write the code you need to price these options using um, this framework, the U parameter is e to the sigma square root of delta t, and D is the inverse, which is this. Okay, so what they're trying to capture is the volatility of the asset and yet still retain the same properties as the Black-Scholes model. Okay, so by having U and D be inverses of each other, we're guaranteeing that going up and then down means the same thing as going down and then up. And it has a furthermore the helpful benefit that this brings us to the same point we started out with. Although that part isn't absolutely necessary, we can still have a recombining tree where these two are not equal to each other, but in here they are equal to each other. So up and then down is the same as down and then up, and both of those mean that we've came back to the original position. So the American options, this is this is the clever part. What's happening here is this. Let me sketch this out for you. And so this is how we extend the model to price American options. We start out with the same stock tree. Oops. All right, here's where the fun begins. It's the value of the option at the interior nodes that's being complicated, let's say. All right, so the terminal nodes are the same. Okay, so to price an American option, and again, it doesn't matter if it's European, sorry, if it's American or it doesn't matter if it's a call or put, the process is the same. What changes is the payoffs at the terminal nodes. So the values for pricing an American option, the payoffs on the terminal nodes are the same. as they were for the for a European option. Interior nodes are treated a little differently, though, to allow for the potential, at least, for early exercise. So, in other words, with an American option, every day that you wake up and look at your position, you have to make a decision. Should I exercise or not, or should I hold on to it for another day? And be aware that when the option is exercised, if the option is exercised, the investor receives payoff immediately and any cash flows from the asset, but sacrifices the time value of the option. Okay, so in other words, if I'm able to exercise it in 3 months when it's a 6 month option, in 3 months I get the full payoff. But and if the asset has a cash flow, I'll receive that for the next 3 months, which would not have happened had I not exercised it early. But I'm also giving up any time value that's left in the option. So I have to decide, does this make sense or not? So what happens is we're going to combine these payoffs in the following way. So for example, at FU, what we know from before is that the payoff is the max of US0 minus KN0. That assumes that we exercise the option at that point on the tree. If not, so this means this is the value of the option. Oh, I'm sorry, we're assuming a call here. Okay, value of call if exercised early. And if not, this is what we had earlier with the European model. This is the value if not exercised. So the second one is the one we had with the European model. The first one is new. Suddenly we have the opportunity to possibly exercise the option early. So what we're going to do, of course, is choose the greater of the two. So sometimes you see this written as the max of okay, so it's the greater of the two. We're assuming, by the way, that if it makes sense to exercise the option early, we will do so. All right, that's a strong assumption, but it's an assumption that we'll make because investors should presumably understand how this works. And so if it makes sense to exercise early, we'll get the payoff at that time. Otherwise, we'll continue to hold it and we'll have an option which is worth whatever it would have been had it been a European option. So the same thing is going to be true for FD and F. At every one of those nodes, now suddenly we have to introduce the possibility of early exercise. So for example, FD becomes, we'll start with the payoff at that node. And then, of course, we have this, the present value, which means we did not exercise early. And we pick the greater of the two. And then finally, at today's node, we'll have okay. And again, this is assuming it's a call. If it was a put, then those payoffs would be, adjusted for that. All right. So this is for a call. For a put, all we'd have to do is reverse. This would become K minus US0, for example. This would be, of course, K minus DS0, and this one would be K minus S0. Otherwise, it's the same. All right. So that's what's happening with this model. And of course, like I said, you can't do this with the Black-Scholes model because you only observe the probability distribution for the asset at the maturity date in the model. You don't have the ability to inspect it at every point in time because what they're doing is solving a differential equation at the terminal date of the options trading. And so here, though, you're breaking up the process that the stock follows, the assumed binomial process, into discrete steps so you can inspect the values of the option at all these different time steps and make a determination in each case if we should exercise early or not. So that's why this suddenly becomes so powerful. And now, except possibly for exotic options, now anything you see in the marketplace can potentially be priced here. And so suddenly, more or less, the sky is the limit for what kind of options we can price. So this is 1976 now. And you can imagine that after this paper was published, a very large number of new options were introduced in the marketplace because suddenly everyone wants them. And of course, as crises develop in the world financial markets, like the breakdown of the Bretton Woods Agreement in 73, and you might remember in late 70s, 1979, we had something called the October surprise, where US inflation was so out of control that the Fed announced after a meeting on Saturday night that they were changing the way they conduct monetary policy to target the money supply instead of interest rates. And the effect of that was to send interest rates through the roof in a very short period of time because they needed desperately to get inflation under control. And it worked. But for 2 or 3 years there, interest rates were just at astronomical levels, unthinkable levels, like 16% mortgages and that kind of thing. And so that's when a lot of the interest rate derivatives were first introduced because it became clear that there was a desperate need for hedging interest rate risk. And of course, then more and more were introduced. But none of that could have happened if we didn't have this type of option pricing model because most of those options that were introduced are American style. I'd say the majority of the options in the market right now are American style. And in fact, most of those in turn, but not all of them, many of them are futures options. Okay. Not the interest rate ones. Those tend to be European style because they're written on a number, not an actual security. And they're usually used to hedge risk at a specific point in time rather than for an interval of time. But many of the others, like if you buy an option on gold, it's probably a futures option, an option on currencies. In other words, any assets that trade on the futures exchanges, chances are the options written on them are futures options, and they would be American style because you have to have the ability to jump in and convert your option into a futures contract when the need arises. But certain others are still European style. So anyway, so everything is out there for, whatever you need, it's out there as an investor or as a hedger or as a speculator, whatever. So anyway, but pricing with this model really opened the doors Now, the last half of this section, actually, I just realized this is where the Pocal parity proof was hiding. Um, I'd forgotten, and there's also other um, relationships that are being proven here. We don't really have time to do this right now, but um, let's see. Oh, and by the way, what if your asset provides cash flows? Then, of course, we have to put Q's all over the place. And oh, here's the definition of UND. But where would that appear? The probability P and the 1 minus P would be affected if your asset has some kind of a cash flow. Let's see if we can find that formula here. Maybe it's not in this chapter. By the way, you can actually use this model for other purposes too. For example, you can calculate the Greeks. We didn't actually get that deeply into that. Those formulas that we were looking at when we looked at the Greeks were just simply derivatives from the Black-Scholes model. But when you're using a framework like this, you can actually take the nodes off the tree and use them to calculate Greeks. The advantage of doing that is that you can figure out what they would be at different points in the future. And so, the tree gives us a lot of flexibility that we wouldn't have with just the Black-Scholes model. All right. Well, anyway, so that's as far as we can take this, given that we're done with the semester. Um, it's there's so much more. There's so much more fun stuff out there, but we have covered a lot of good material, and we didn't have time for example, Monte Carlo simulation or the trinomial tree, which is kind of sad. But if you're interested, I can send you the notes that I do have. The trinomial tree is basically just uh, a version of this tree, except that instead of just up and down, we allow for up, down, and stay the same. And like I said, the Monte Carlo simulation is really a way of simulating, let's say, the value of a stock over time based on statistical assumptions so that you can generate results with simulation rather than market data. And so it's a very interesting approach, but it really only makes sense for exotic options. Okay, you could theoretically use it for American options, but it's very, very awkward. And for European options, it would be gross overkill. You might as well just use Black-Scholes because it's very time consuming. But anyway, so this is a brief look at the binomial option pricing model. And so I guess we'll have to knock it off right there. Hopefully, you all found, I put on Blackboard. I don't think I forgot. The assignment is in there plus the template. Hold on a second. Let's see. I want to make sure that everything is in there. To get your assignment done, you will need, of course, a copy of the questions, and you'll need that template that we created in the previous session. I'm pretty sure they're there, but let's just go make sure. Yeah, sometimes it gets strange. I don't know what this is supposed to be. Okay, that's better. Ooh, luckily it's not the 28th. All right, let's just make sure everything's in there. So, there's the template. You can use that for to get you started on pricing options with Black-Scholes. I included, remember, some of the code, but not all of it, to get you started. And you know what? I really, it doesn't look like, yeah, I thought it was in there. I guess not. All right, let me put it in there now. The questions, I mean, there it is. Sometimes it's easy for things to get lost in here. There's so much material. All right, those are the questions. It just tells you what options you should be pricing for your final assignment. And then, of course, we'll include today's results. And of course, as usual, I'll post the videos. Now, of course, today we had to break it up into two pieces thanks to the internet not working. Um, at least not working well. All right, hold on one second. And then the power was behaving strangely last night. There we go. Let's get that in there. It's not happy today. All right, so that's the results of doing the option pricing model, the binomial option pricing model. This is the one that asks you to price two options, two Black-Scholes options with the Black-Scholes model. And then these are the results of this is the template. This is that document I wrote out where I was writing out all the assumptions. And then we have all the different notes. So it should all be here. So if the second half of this class runs probably next spring, if it does, we'll start with a trinomial option pricing model, and then we'll do the Monte Carlo, and then we'll take it from there. We're going to be looking at more specialized. Probably we'll have time to take a closer look then at exotic options because then we'll have done Monte Carlo simulation and we'll be able to take a closer look at them. And then there might be other uh, modeling techniques we can look at. Trying to remember what some of them are, but it's been a while since we ran the second half of this class. It was definitely before the COVID, but a lot of the interesting things we didn't have time for here, we have a chance to take a closer look at. So anyway, so we'll see what happens with that. But in the meantime, just have those programs written by hopefully Sunday night or maybe Monday morning, at which time they will expect me to send in the grades, and then we'll be all set. So these will stay in the Blackboard as long as you want to download them and read them. I'll just leave them there. I don't think there's a time limit on this. So anyway, well, it's been fun, and maybe I'll see you again in the spring. So I hope you had a good time this semester. Bye.